Picture this. AI now handles customer service, manufacturing, and even creative work. The technology is efficient, so efficient that McKinsey estimates 14% of U.S. workers have already lost jobs to automation or robots. Globally, around 40% of jobs could be affected by AI by 2030, according to the IMF. That's not just a statistic, it's a sign of how quickly the landscape is shifting. But there's a catch. When companies cut costs by automating jobs, they risk wiping out the very consumer base they depend on. In this video, we'll explore why today's corporate cost-cutting could undermine tomorrow's customers, and how this cycle threatens the entire economy. The 2025 automation boom. The pace of automation in 2025 stands out not just for its speed, but for the breadth of its impact. Around 40% of jobs worldwide now face significant exposure to AI-driven automation, a sharp increase from just a few years ago. This transformation is no longer limited to factory floors or assembly lines. Instead, it cuts across industries, from manufacturing and customer service to banking and logistics. The numbers behind this shift are hard to ignore. For instance, McKinsey estimates that the productivity potential of AI and automation could reach $4.4 trillion globally. IBM reports that 77% of businesses are already integrating AI into their processes, and McKinsey found that 92% of companies plan to increase their investments in AI technology. The manufacturing sector, once a reliable source of stable employment, now faces some of the highest automation risks. Research shows that nearly 59% of manufacturing activities could be automated with current technology, and up to 20 million manufacturing jobs worldwide could be lost to robots by 2030. Machine operators, assemblers, and welders, roles that involve repetitive, predictable tasks, are being replaced by robotics and AI vision systems at a rapid pace. In parallel, customer service is undergoing its own transformation. Call centers that have implemented AI-driven chatbots and virtual agents report headcount reductions of 26% within a single year, according to a Metro GA survey. In e-commerce, 36% of live support roles have already been automated away in companies with more than 200 employees. These changes aren't limited to blue-collar jobs. In the financial sector, AI algorithms now handle many clerical tasks, from processing transactions to basic risk analysis. Bank tellers and loan processors, once seen as secure positions, are increasingly redundant as customers shift to AI-assisted digital banking. Similarly, in retail, self-checkout kiosks and automated inventory management have led to steep declines in traditional roles. In the United States alone, jobs for retail salespersons and cashiers are projected to shrink by over 600,000 each by 2030. These are not distant projections. They reflect a present reality where technology is rewriting the rules for millions of workers. The financial logic driving this shift is difficult for companies to resist. Automation promises immediate reductions in labor costs, increased productivity, and higher profit margins. Walmart's use of autonomous shelf-stocking robots has saved millions per distribution center each year, while AI-powered checkout systems at Target have reduced cashier hours by nearly half in pilot stores. For shareholders and executives, these numbers are compelling. Yet, few companies consider the broader consequences. Only a small fraction conduct economic impact studies that look beyond their own bottom lines. The focus remains on short-term gains, cutting jobs and boosting efficiency, without accounting for the long-term effects on demand. The result is a growing disconnect between efficiency and sustainability. As more jobs are automated, the pool of consumers with disposable income shrinks. The very workers who once powered these companies as both employees and customers are being pushed out of the economy. Unlike past technological revolutions, which played out over generations, the current wave of AI-driven automation is unfolding within a single decade. The Bureau of Labor Statistics notes that since 2020, automation has already erased millions of jobs, with losses concentrated in office administration, customer service, and transportation. The effects now reach into roles that require advanced education, not just manual labor. This rapid shift raises a fundamental question that today's executives rarely address. What happens to demand when so many workers are left behind? The answer is not just a matter of corporate strategy, but a challenge to the entire economic system. A challenge that echoes lessons from history, which some leaders have forgotten. The Henry Ford paradox. This brings us to what economists call the Henry Ford paradox, a lesson from industrial history that's often overlooked in today's rush to automate. In 1914, Henry Ford doubled his workers' wages to $5 per day, a move that stunned the business world. The decision wasn't simply about generosity. Ford's factories faced crushing turnover rates, with some estimates putting annual attrition at nearly 370%. Workers left because the job was grueling and the pay was low. Ford's wage hike stabilized his workforce, but it also did something more important. It aligned productivity with purchasing power. By paying his employees enough to afford the cars they built, priced around $700 to $800 at the time, Ford turned workers into customers, creating a feedback loop that boosted both sales and loyalty. Brookings research highlights how this approach spurred demand and helped build the American middle class. The results were immediate. Ford's turnover rate dropped by about 70%, and the company saw a 48% jump in sales within a year. The policy became a model for how higher wages could drive economic growth, not just for Ford, but for the entire manufacturing sector. Ford's move also generated headlines and praise, with newspapers hailing it as a bold new standard for American industry. While there were strings attached, such as Ford's sociological department enforcing certain standards of living, the core idea was clear. Investing in workers could pay off by expanding the consumer base. Contrast that with today's automation strategies. Modern corporations often see labor as a cost to be minimized, not an asset to be cultivated. According to McKinsey, the average S&P 500 company now spends more than half its operating budget on labor reduction initiatives. Instead of building a loyal customer base from within, businesses cut jobs to boost short-term profits. Amazon's warehouse automation eliminated 32,000 positions last year. At the same time, Amazon reported slowing growth in Prime membership renewals, an indication that former employees, now out of work, are less likely to remain customers. This pattern repeats across industries. In the 1920s, manufacturing output soared while wages barely budged, setting the stage for the Great Depression as workers could no longer afford the goods they produced. Today, the gap between productivity and compensation has widened even further. Since 2000, productivity has grown 3.5 times faster than wages, echoing the same warning signs as a century ago. Automotive data makes the paradox visible. Tesla's Fremont factory produces 500,000 vehicles annually with 20% fewer workers than comparable Toyota plants. Yet, Tesla's U.S. sales growth slowed to 1.5% in 2024, while Toyota, which maintains more dealership jobs, saw higher growth. The jobs that Tesla cut were also potential customers for its financing and service divisions. In banking, AI-powered customer service at Bank of America handled millions of inquiries with thousands fewer staff, but internal research found that each lost job led to fewer loan applications, costing the company in future revenue. Retail and tech sectors face similar contradictions. Walmart's automation reduced labor costs by $1.2 billion last quarter, but same-store sales dipped almost immediately. Google's ad business depends on small enterprises, but as it automates sales and support roles, it erodes its own customer base. In food service, McDonald's saw profit margins rise after installing digital kiosks, only to watch same-store sales growth turn negative as former employees could no longer afford to eat there. Investment strategies often make matters worse. Private equity firms automate jobs, extract short-term profits, and move on before the decline in local spending catches up. National Association of Manufacturers data shows that firms replacing large portions of their workforce with automation report slower revenue growth than those that keep more people employed. Even in healthcare and education, automation cuts into the very populations that sustain demand, as job losses lead to fewer patients and fewer students able to afford services. As automation accelerates, the logic that once made Ford's factories thrive is being reversed. Instead of workers becoming customers, they're being sidelined. This shift has opened the door for a new kind of business model, one that doesn't depend on a broad base of consumers at all. The freemium economy. The freemium economy has become a defining feature of how businesses operate in the era of automation. Nowhere is this clearer than in the video game industry, which has quietly surpassed the combined revenues of the music, film, and television sectors. The core of this model is straightforward. Most users pay nothing, while a small group of whales spends disproportionately on in-game perks and upgrades. These whales typically don't rely on traditional paychecks. Instead, they benefit from income-producing assets, reflecting a broader economic shift where the value of labor declines and asset ownership becomes the main source of purchasing power. This approach is no longer confined to gaming. High-end brands and luxury services increasingly target the same kind of asset-rich clientele. For instance, Lamborghini sold more cars in the last decade than in the previous 60 years combined, a trend driven by buyers whose wealth comes from investments rather than wages. In retail, Amazon's data shows that Prime members in the top income brackets spend vastly more than typical subscribers, and companies like Walmart are expanding services that cater to affluent customers. Private jet fuel sales, for example, even as overall grocery sales stagnate. The focus shifts toward maximizing returns from a small, wealthy segment, while automation trims jobs that once supported broader consumer demand. The financial sector reveals a similar pattern. Goldman Sachs reports that the majority of deposits on its Marcus platform come from a small fraction of clients, primarily business owners and investors. Across banking, traditional wage earners now make up a shrinking share of assets under management. Banks invest more in automated trading systems and digital platforms, serving clients who generate revenue through capital rather than labor. This shift in priorities leaves fewer resources devoted to services aimed at the broader public. Hospitality and healthcare are not immune. Luxury hotel chains like Four Seasons report record occupancy rates, with a small percentage of guests generating most of the revenue. These guests, often CEOs or asset managers, expect and receive automated, high-end services. Meanwhile, budget hotels and community hospitals struggle, cutting staff and closing departments as their customer base erodes. In healthcare, elite executive programs expand while hospitals serving wage earners face layoffs and closures. The system increasingly orients itself around those who hold capital, not those who work for wages. Technology platforms amplify this divide. Shopify's data shows that a small percentage of store owners, mainly established brands with significant resources, generate the majority of revenue. Tesla's premium vehicles are now primarily sold to households with substantial investment portfolios, often purchased outright rather than financed. In education, top business schools and online learning platforms focus on executive programs for current leaders, not on expanding opportunities for the broader workforce. The underlying trend is clear. As automation advances, businesses are building models that rely on extracting maximum value from a narrow group of high-net-worth individuals, while the majority are increasingly sidelined. The freemium economy works in gaming because a handful of whales can subsidize millions of non-paying players. But when this model spreads across industries, the risks multiply. If every sector depends on a shrinking pool of asset-rich customers, the foundation of consumer demand weakens. Service jobs disappear, and the broader population's ability to participate in the economy diminishes. This imbalance becomes more pronounced as automation accelerates. The feedback loop that once linked worker pay to consumer spending breaks down. The more businesses automate, the more they cut off their own future markets. The result is an economy that appears efficient on the surface, but grows increasingly fragile beneath. This fragility is now playing out in sectors where automation and job loss are most visible, setting the stage for deeper economic challenges ahead. The call center collapse. Call centers illustrate the impact of automation more clearly than almost any other sector. Over the past year, companies have ramped up their use of AI in customer service, with nearly 37% of firms adopting AI-driven contact center solutions and laying off more than a quarter of their workforce on average. This isn't just about entry-level staff losing jobs. Experienced agents who once handled complex technical issues and billing disputes are also being replaced by automated systems capable of managing tasks that required human judgment just months before. The financial incentives for companies are obvious. Telecom providers, for example, have reported substantial savings by automating support roles. One major carrier cut thousands of jobs and saved over $100 million in a single year, as AI chatbots began to resolve most customer inquiries without human help. But these same companies often overlook the broader consequences. Analysis of subscriber data reveals that many of those laid-off employees were also loyal customers, frequently upgrading devices and purchasing additional services. When these workers lose their jobs, they also stop buying the products and services they once sold and supported. This pattern repeats across industries. Credit card companies have automated nearly half of their dispute resolution calls, while major banks now rely on AI to handle tens of millions of customer interactions every quarter. The reduction in staff is significant, but so is the impact on demand. Internal analyses from several financial institutions show a direct correlation between job cuts and reduced uptake of new products in the communities where layoffs occur. In other words, every position eliminated doesn't just save costs, it erodes the customer base. Healthcare is not immune. Large insurers have replaced thousands of claims processors with AI systems, only to find that many of those workers were also policyholders or dependents. The automated systems may efficiently process claims, but the loss of stable, middle-income jobs means fewer people can afford coverage in the first place. In retail, chains that automate customer service functions see sharper declines in sales in regions hit by call center closures. The employees who once explained products and services to customers were often the same people making those purchases themselves. The shift to automation is especially stark in countries where call centers provided a path to the middle class. In Brazil, AI integration has reduced staffing by nearly a third in major cities. In the Philippines, demand for English language support remains high, but hiring is down by nearly a quarter as companies automate routine inquiries. Each job lost represents a consumer removed from the economy, someone who used to spend their paycheck on the very products and services they supported as workers. While some new roles have emerged, such as AI trainers and escalation specialists, these positions require advanced technical skills and are far fewer in number than the jobs they replace. The majority of displaced workers find it difficult to transition into these new roles without significant retraining, and the wage gap between traditional call center work and AI oversight positions is substantial. Even management is not immune. AI now monitors and evaluates customer interactions, reducing the need for human supervisors. Financial institutions and telecoms have cut a significant share of their managerial staff, eliminating roles that were once filled by reliable, high-spending customers. The loss of these positions further reduces demand for products like mortgages, loans, and premium services. Customer experience metrics also reveal the trade-offs. While AI can handle routine questions quickly, customer satisfaction rates drop when interactions become more complex. Human agents consistently resolve issues more effectively, and customers forced through automated systems are less likely to remain loyal. Companies that maintain human staff call centers report higher retention rates, but the pressure to cut costs often overrides these long-term considerations. As automation continues, the sector loses not only its workforce but also its most knowledgeable and dedicated customers. The cycle is self-reinforcing. The more jobs are automated, the smaller the pool of consumers able to sustain the business. This dynamic is not limited to call centers. It is a sign of a broader shift in the economy, where companies increasingly rely on a shrinking group of high-spending customers to drive growth. The luxury boom. In the midst of widespread job losses and shrinking opportunities for wage earners, luxury brands are reporting record growth. Lamborghini, for example, has sold more cars in the past decade than in its entire previous history. High-end watchmakers like Patek Philippe face waitlists that now stretch for years, even as prices have doubled since 2019. This surge isn't limited to a few brands. It's a trend that spans the entire luxury sector, with sales data from companies like Bentley and Ferrari showing similar patterns. The rise in demand is fueled by a growing number of wealthy individuals whose fortunes are tied to asset appreciation rather than earned income. As automation and technology suppress wage growth for most, those with even modest investment portfolios have seen their wealth multiply. The contrast with the broader economy is stark. Luxury goods sales rose 14% last year, according to Bain & Company, while department store revenues fell 6%. Porsche reported an 18% increase in U.S. deliveries, but mainstream automakers like Toyota saw little to no growth. Private jet traffic has reached new highs, with NetJets logging 27% more flight hours, while commercial air travel remains below pre-pandemic levels. Art auctions show a similar divide. Sotheby's sold 43% more artwork above $10 million, but smaller galleries saw declining attendance. The core driver is clear. Asset inflation has lifted the spending power of the wealthy, while wage earners are left behind. Automation sits at the heart of this divide. The same technologies that eliminate middle-income jobs also boost corporate profits, funneling gains to shareholders and business owners. When large retailers automate thousands of positions, their stock prices often rise, rewarding those who hold assets. Private equity firms now seek out companies with high automation potential, betting on cost savings that benefit investors but remove steady jobs from the economy. The result is a cycle where the value of human labor stagnates, but the value of assets continues to climb. Corporate strategies reflect this shift in focus. Nordstrom's recent investor briefings laid out plans to close dozens of mid-range locations while expanding flagship stores in wealthy urban centers. Luxury automakers now direct most of their marketing budgets toward households with multi-million-dollar net worth. These decisions aren't accidental. They represent a deliberate pivot toward serving high-net-worth individuals, even as the broader consumer base weakens. History offers warnings about relying too heavily on luxury demand. Before the French Revolution, luxury merchants thrived while the cost of basic goods soared for ordinary people. Similar patterns appeared in the Gilded Age, when economic extremes led to social and political upheaval. Today, luxury brands continue to expand, but mainstream retailers report declining sales and shrinking foot traffic. The infrastructure that supports luxury consumption, roads, air traffic control, skilled service workers, relies on a healthy middle class. As wealth concentrates, these systems become harder to maintain. Financial markets are already showing signs of concern. Even as luxury conglomerates post record earnings, their stock prices have wavered. Analysts point to doubts about how long growth can continue if the majority of consumers are left out. Middle-class households still drive most consumer spending, accounting for over 60% of U.S. retail activity. Companies that neglect this demographic eventually face growth limits, as seen when Apple missed earnings targets due to longer phone replacement cycles among average buyers. Automation only deepens the contradictions. While luxury brands hire a handful of highly paid designers and executives, they eliminate far more jobs in retail and service roles. The creative class that produces luxury goods depends on a broader workforce that is steadily being reduced. Some brands have started to acknowledge the risk. Internal documents from watchmakers and car companies show concerns about the shrinking pipeline of new customers, as fewer young professionals reach the income levels needed to participate in the luxury market. Supporting services are feeling the strain as well. High-end restaurants report shortages of skilled chefs, and country clubs struggle to find experienced staff. The traditional middle-class career paths that once supplied these roles are disappearing. Even the wealthy rely on a functioning ecosystem of workers, infrastructure, and services, an ecosystem that automation and wealth concentration threaten to undermine. Despite the clear risks, investment continues to flow into businesses that cater exclusively to the ultra-wealthy. Analysts predict that households with $25 million or more in assets will soon account for the majority of discretionary spending. But as the economy becomes more polarized, the limits of this model become harder to ignore. The long-term stability of any market depends on broad participation, not just the spending of a privileged few. With these pressures building, some policymakers and business leaders have begun looking for solutions to restore balance. One of the most discussed ideas is to provide direct financial support to those left behind by automation. Yet, as early experiments show, this approach is not without its own challenges. The UBI experiment, Universal Basic Income, or UBI, is often put forward as a response to the economic upheaval caused by automation, promising a safety net for those whose jobs disappear. But the results from recent large-scale trials reveal the complexities and shortcomings of this approach. In a 2024 study funded by Open Research, 1,000 people in Texas and Illinois received $1,000 a month with no conditions attached, while a control group of 2,000 received just $50. The findings were clear. Those receiving the full UBI payments ended up earning less from work, choosing instead to reduce their hours and spend more time on family or leisure. This shift aligns with the optimistic vision of an AI-powered future where machines do the work and people have more free time, but it also exposes a central problem. Less work means less earned income, and UBI doesn't fully make up for this lost spending power. The study's economic implications are hard to ignore. Participants who cut back on work didn't increase their overall spending. Instead, they lived on smaller combined incomes from work plus UBI, often prioritizing essentials over discretionary purchases. This is critical for an economy driven by consumer demand. When former full-time workers transition to part-time work supplemented by government payments, the total amount of money flowing into the marketplace contracts. Rather than redistributing wealth to maintain economic activity, UBI in this context risks reducing it, especially if large portions of the population depend on it. UBI's psychological benefits also proved fleeting. While mental health and food security improved early in the study, these gains faded by the end. What starts as a relief from financial stress can quickly become a new baseline, with the underlying issues of lost purpose and diminished economic participation resurfacing. The evidence suggests that while UBI can provide immediate relief from poverty, it does not offer a long-term substitute for meaningful work and the sense of agency that comes with it. There are also practical limitations to UBI's effectiveness. Even a relatively generous $1,000 monthly payment only replaces a fraction of the typical household income that supports consumer spending. Scaling UBI to fully offset lost wages would demand tax revenues that are difficult to collect, especially as automation erodes traditional income and payroll tax bases. Attempts to fund UBI through increased corporate or wealth taxes face their own challenges, as large companies often minimize taxable income through deductions, and asset values can fluctuate unpredictably. The impact on the labor market is another concern. The same study found UBI recipients were less likely to accept lower wage or undesirable jobs, creating shortages in roles that still require human presence, such as service and care work. This outcome could lead to gaps in essential services, even as unemployment remains high in other sectors. Geographic disparities also complicate implementation. Recipients in higher-cost cities struggled more than those in rural areas, despite identical payments, raising questions about how a national program could equitably address regional differences. Public support for UBI can also be fragile. The study noted that attitudes shifted when people learned recipients worked fewer hours, with some voters growing skeptical about providing ongoing payments to those who appeared to be opting out of the workforce. This could limit the political feasibility of UBI, especially if it's seen as a permanent replacement for employment rather than a temporary bridge. Finally, UBI does little to address the underlying economic contradiction. As automation eliminates jobs, companies save on labor costs but lose the very customers they rely on. Government transfers may soften the blow, but they don't restore the broad-based purchasing power that a healthy economy requires. As the value of work declines and more people depend on fixed payments, the divide between those with assets and those without the asset bubble. As automation transforms the workplace, the focus shifts to the rising value of income-producing assets. Stocks, real estate, and other investment vehicles are appreciating at a pace that far outstrips the growth of wages. This dynamic is not limited to the ultra-wealthy. Even moderate investors have seen their portfolios balloon, while those reliant on paychecks struggle to keep up. The result is a feedback loop. As asset values climb, owners reinvest their gains, further inflating prices and deepening the divide between asset holders and wage earners. Corporate financial strategies highlight this divide. S&P 500 companies now direct most of their cash flow toward stock buybacks and dividends, not toward hiring or wage increases. For example, Tesla spent billions on share repurchases last year while cutting 14% of its workforce. This approach boosts executive compensation and shareholder wealth, but it does little to support those whose jobs are lost to automation. The more companies automate, the more they reward those who already own a stake in the system. Real estate markets reflect similar trends. Commercial property values have surged, even as vacancies remain high. Automated valuation models drive up prices based on projected rental income, not actual demand. Investors compete for properties, leveraging easy credit to expand their holdings. Meanwhile, former office workers, now displaced, find themselves priced out of starting businesses or even affording commercial rents. The cycle favors those with assets and sidelines those without. Stock market behavior has become increasingly disconnected from the real economy. Companies like Nvidia and Microsoft have seen their market values soar, even as they reduce headcount. Investors reward cost-cutting and automation with higher share prices, reinforcing the idea that labor is expendable. Stock ownership itself is becoming more concentrated. Middle-income households now hold a shrinking share of financial assets, making it harder for new entrants to build wealth through traditional means. Access to assets is narrowing. Households earning under $100,000 now control just a small fraction of total financial assets, a share that continues to drop as asset inflation outpaces wage growth. First-time homebuyers face down payments that are out of reach, and stock market participation among younger generations is declining. At the same time, corporate pension plans increasingly shift risk onto workers by tying retirement savings to company stock, exposing employees to the volatility of markets they have little power to influence. Credit trends further widen the gap. Banks prefer to lend to those who already have significant assets, allowing the wealthy to borrow against appreciating portfolios and acquire even more. This cycle of leveraging and reinvestment amplifies asset price growth and leaves wage earners behind. Luxury goods and alternative investments like rare watches or collectible whiskey have become stores of value for investors flush with gains, creating closed markets where wealth circulates among a small group of buyers. Automation accelerates these patterns. Companies that invest in labor-saving technologies see their stock prices rise, attracting more capital and enabling further automation. Venture funding for AI startups often comes from institutional investors and pension funds seeking returns, reinforcing the concentration of wealth among asset holders. The tax system compounds the issue, as capital gains are often taxed at lower rates than ordinary income, encouraging compensation structures that favor equity over salaries. The psychological effects are visible. Surveys show that many young people believe homeownership and asset accumulation are out of reach, and fewer are participating in markets that once built middle-class wealth. This expectation becomes self-reinforcing, as those who feel excluded are less likely to attempt to build assets in the first place. Even companies are beginning to notice the consequences. Internal research at major firms shows that as automation eliminates jobs, demand for their own products and services declines in affected regions. The feedback loop that once connected worker pay to consumer demand is breaking down, and the broader market begins to feel the strain. These shifts highlight a core problem. As wealth concentrates in the hands of those who own assets, the underlying economic foundation weakens. The market continues to assume there will be consumers and workers to support rising valuations, but as more people are excluded from asset ownership and stable employment, that assumption grows more fragile. The search for solutions often turns to retraining and upskilling, but the reality of these programs rarely matches the scale or speed of the changes underway. The retraining myth. Despite the widespread promotion of retraining as a solution to automation, the reality on the ground is far less promising. The idea that workers can simply learn new skills and move into fresh roles assumes a level of stability and predictability that no longer exists in today's job market. Many retraining programs end up mismatched with the actual needs of employers, and the pace of technological change often leaves workers behind before they even complete their courses. For example, a Department of Labor study found that workers who finished federally funded retraining in 2023 saw only modest gains in income, and a significant portion remained unemployed months after graduating. The promise of a smooth transition from one career to another rarely materializes. The rapid evolution of AI and automation means skills can become obsolete almost overnight. A former truck driver might spend a year in a coding boot camp, only to discover that entry-level programming jobs are now handled by AI tools that outperform most new graduates. Companies like IBM have paused hiring for thousands of roles after finding that their own retrained employees could not keep up with the latest AI systems. Even when workers manage to complete retraining, there's no guarantee that the new job will last. The cycle is relentless. As soon as workers adapt, the technology moves on. Capacity is another major issue. The scale of displacement far exceeds what retraining programs can handle. In the U.S., hundreds of thousands of manufacturing and service jobs are lost each year to automation, while the largest government retraining programs serve only a fraction of those affected. Community colleges and job centers face long wait lists for popular programs, many of which train for roles already declining due to automation. The mismatch between available training and labor market demand leaves many without viable options. Quality and relevance are persistent problems. Government audits have found that a significant portion of retraining courses teach outdated material, sometimes focusing on technologies or systems that employers no longer use. Workers can spend months learning skills that provide little to no advantage in the current market. High-profile corporate retraining initiatives often fall short as well, with low retention rates and limited advancement for participants. The reality is that many programs do not align closely enough with the evolving needs of employers or the broader economy. Age and adaptability play a role in retraining outcomes. Older workers, in particular, find it more difficult to transition into tech-heavy roles. They require more time and support, yet most programs are not designed to address these challenges. Financial constraints, family responsibilities, and the stress of starting over make the process even more daunting. For many, the prospect of uprooting their lives for uncertain job prospects elsewhere is simply not feasible. Geography further complicates matters. Retraining programs often prepare workers for jobs that are not available in their local communities. This forces people to consider moving, which is not always possible due to cost, family ties, or lack of support. Rural areas are especially hard hit, with many retrained workers needing to travel long distances or relocate entirely to find employment. The result is a growing sense of frustration and disillusionment among those left behind. Employer involvement in retraining is limited. While companies talk about upskilling, actual investment in workforce development has declined. Many prefer to hire workers who already possess the necessary skills, rather than invest in training existing staff. Corporate retraining programs often serve as public relations tools rather than genuine pathways to stable employment. Even when retraining leads to new jobs, those positions are increasingly vulnerable to automation themselves. Workers may move from one at-risk occupation to another, only to face displacement again within a few years. As AI systems become more capable, the window for human employment in many fields continues to shrink. This constant churn leads to instability and burnout, especially for those who have already endured multiple rounds of job loss and retraining. The limitations of retraining are not just technical, they're structural. Funding models often reward training providers for enrollment rather than successful job placement, leading to programs that prioritize quantity over quality. Some for-profit colleges and online platforms push workers into debt for certifications that hold little value in the labor market. Even the training industry itself is adopting automation, replacing human instructors with AI-driven learning systems. Younger workers face their own set of challenges. Many enter the workforce with significant debt, only to find that their chosen fields are already being automated. The assumption that new graduates will have time to build experience before facing technological disruption no longer holds true. Instead, they are forced to pivot repeatedly, often without a clear path to stable employment. Ultimately, retraining alone cannot keep pace with the speed and scale of automation. The belief that every displaced worker can simply be educated into a new role ignores the realities of today's labor market. As more people struggle to find secure work, the effects ripple outward, reshaping entire communities and local economies. The consequences of this mismatch are becoming more visible, especially in regions where automation is accelerating job loss and economic decline. The ghost town effect. Communities across the country are beginning to experience what economists call the ghost town effect, a gradual hollowing out of local economies as automation quietly eliminates jobs that once anchored entire regions. Unlike the sudden blow of factory closures or mass layoffs, automation erodes opportunity in slow, almost invisible increments. The process starts with a few job cuts in manufacturing or retail, but over time, the cumulative loss becomes impossible to ignore. In manufacturing hubs, the shift is especially pronounced. Industrial robots now handle assembly and machine operation, roles that once provided stable employment for thousands. A mid-sized city with 12,000 manufacturing jobs might see just 5% of those roles automated away in a year, seemingly minor until you factor in the ripple effect. Each lost factory job supports additional positions in restaurants, shops, and local services. Over 5 years, the loss compounds. Thousands of jobs vanish, school enrollments drop, and the tax base shrinks. Public services like hospitals, libraries, and bus routes begin to disappear, not because of any single event, but because the foundation that supported them has eroded. Retail towns are seeing a parallel decline. As e-commerce and self-checkout systems expand, traditional cashier and sales roles disappear. Malls that once served as economic anchors lose their major tenants one by one. Between 2017 and 2022, anchor store closures hollowed out shopping centers, leaving behind empty corridors and shuttered storefronts. The impact isn't confined to the mall itself. Local diners, dry cleaners, and small businesses dependent on retail workers and shoppers all feel the strain. Instead of a dramatic collapse, it's a slow, steady draining of vitality from the community. The transportation and logistics sector faces a similar trajectory. Automation in trucking and warehousing is just beginning to reshape the landscape. Even a modest shift toward autonomous vehicles or robotic warehouses can reduce demand for drivers and support staff. A traditional trucking hub might replace hundreds of drivers with a small team maintaining autonomous fleets. The economic consequences extend beyond the companies themselves, affecting truck stops, motels, and local suppliers that once thrived on steady traffic. Service industries, often overlooked in discussions about automation, are not immune. Hospitals and clinics, once among the largest employers in many towns, are automating administrative and billing roles. The hospital may remain open, but the loss of hundreds of steady paychecks means less spending at neighborhood stores and restaurants. The effect is subtle but cumulative, spreading through reduced consumer demand rather than high-profile layoffs. Data from Brookings and other analysts shows that the risk of automation is not evenly distributed. Counties with high concentrations of routine manual or clerical work face far greater exposure. In some manufacturing-heavy regions, up to 60% of jobs are at risk over the next decade, compared to less than a third in tech-focused cities. This divide creates distinct economic fault lines. Some areas adapt and grow, while others quietly fade as opportunities dry up. Local case studies make the trend clear. In Anderson, Indiana, automation in the auto parts sector led to a 37% workforce reduction in just a few years. Production didn't decline, but tax revenue fell, school enrollment dropped, and downtown vacancy rates soared. The businesses that remain cater to a shrinking customer base, and the community struggles to attract new investment. Galesburg, Illinois, after losing its major factory, has yet to recover household incomes or population levels, despite years of economic development efforts. Urban areas face their own version of the ghost town effect. As offices automate administrative work and more jobs shift to remote or algorithmic management, downtown businesses, cafes, cleaners, transit systems lose the daily foot traffic they depend on. The commercial real estate market feels the pressure, with property values dropping and vacancy rates rising. The underlying pattern is clear. Automation's efficiency gains at the company level add up to economic fragility at the community level. Each business decision to automate is rational in isolation, but when repeated across entire regions, these choices drain the economic life from towns and cities. Policymakers and corporate leaders often recognize the problem only after the damage is done, when recovery is far more difficult. As these trends accelerate, the disconnect between rising corporate profits and declining community well-being becomes harder to ignore. The push for ever greater efficiency is reshaping not just individual companies, but the economic landscape as a whole, raising important questions about who ultimately benefits from the next wave of technological investment. The AI investor paradox. The AI investor paradox is shaping the investment landscape in ways that seem at odds with long-term economic health. Investors are pouring billions into AI and automation startups, chasing the promise of efficiency and disruption. Last quarter alone, venture capital firms committed over $40 billion to these technologies. Yet, these same investors rely on healthy consumer markets to generate returns across their portfolios. The paradox is clear. The very innovations attracting capital threaten to undermine the customer base that supports other investments. This contradiction is easy to spot in individual deals. Sequoia Capital, for instance, leads funding rounds for AI legal platforms designed to automate contract review, a process that could displace thousands of white-collar workers. At the same time, Sequoia holds stakes in companies like DoorDash and Airbnb, which depend on millions of middle-class consumers. Andreessen Horowitz follows a similar playbook, backing both robotics firms and consumer brands. the pattern repeats. Investors chase automation's potential, even as it threatens the demand their other companies need. Corporate venture funds highlight the tension even more. Walmart's investment arm backs robotics and cashierless checkout systems that could reduce its workforce, despite internal data showing that a drop in retail employment leads directly to fewer store visits. In effect, the company invests in technologies that may shrink its own customer pipeline. Private equity firms like Blackstone hedge their bets by acquiring both human-operated call centers and the AI startups aiming to replace them. This dual approach reveals a focus on short-term profit, with little thought for the shrinking market that could result. The automotive sector offers a stark example. Major investors in Tesla also fund autonomous driving startups that could eliminate millions of jobs in transportation. Morgan Stanley projects that full autonomy could erase up to 5 million driving jobs in the U.S. over the next decade. Yet, these investors expect vehicle sales to continue growing, even as the technology they support reduces the number of people able to afford cars. The video game industry's freemium model serves as a warning. Companies now rely on a tiny fraction of high-spending users, so-called whales, to subsidize free access for the majority. Venture capitalists have started applying this logic to other sectors, funding startups that cater primarily to affluent customers. This approach works until too many industries compete for the same pool of elite spenders, leaving the broader market behind. Market data points to growing risks. While S&P 500 profits reach new highs, consumer debt has hit $17.5 trillion, and wage growth has lagged behind productivity for decades. As AI threatens jobs that support this debt, the risk of defaults rises, potentially undermining the portfolios investors depend on. In Silicon Valley, the concentration of AI and consumer-facing startups in the same neighborhoods makes it easy for investors to overlook the broader consequences of automation on demand. Publicly traded companies reflect the same short-term focus. NVIDIA's market value soared as its chips powered AI systems that automate jobs across industries. Yet, NVIDIA's long-term growth depends on robust consumer demand for its products, demand that widespread automation could threaten. Insurance and finance face similar contradictions. AI underwriting tools threaten to automate away large portions of their own workforce, even as these companies need stable, employed customers to sustain policy volumes and investment returns. Pension funds, like CalPERS, invest heavily in AI startups while representing workers whose jobs are at risk from these very technologies. The timeline of venture capital only deepens the disconnect. Most funds operate on a 7 to 10-year horizon, often cashing out before the full effects of automation ripple through the economy. This short window encourages investment in labor-reducing technologies without regard for the long-term impact on demand. As more companies tout AI-driven labor savings to justify their valuations, the core dilemma grows more pronounced. Investors celebrate efficiency, but they rarely ask what happens if the majority of consumers can no longer participate in the market. This paradox sits at the heart of the current investment boom, raising questions about whether today's productivity gains can really deliver lasting prosperity. The productivity mirage. Productivity gains from AI and automation are frequently touted as the solution to economic stagnation, but the benefits are far from evenly distributed. On paper, companies report impressive efficiency improvements. Amazon's warehouses, for example, now move significantly more packages per hour with a smaller workforce. S&P 500 firms show double-digit productivity increases since 2021. Yet, these advances rarely translate into broad prosperity. Median household income barely budges after inflation, and GDP growth remains sluggish, exposing the disconnect between corporate efficiency and everyday economic well-being. Much of this new productivity is captured by a handful of large tech companies and their investors. Microsoft's AI tools have made engineering departments more efficient, but instead of hiring more staff, the company cut jobs. Shareholders benefit, but workers find fewer opportunities. When Meta automates content moderation, thousands of jobs disappear, and those former employees no longer have the income to spend on the very platforms they helped maintain. In each case, the productivity improvements look impressive in financial reports, but mask the shrinking pool of consumers who can actually participate in the market. Manufacturing is a clear example of this imbalance. Tesla's Fremont plant produces more vehicles each year with a steadily shrinking workforce. Theoretically, if this trend continues, very few workers will be needed at all. But auto workers make up a significant portion of new car buyers. When jobs disappear, so does the demand for the products these factories produce. The cycle undermines itself. The more efficient production becomes, the fewer people are left who can afford what's made. Service industries show similar distortions. At Bank of America, AI-driven fraud detection processes more transactions with fewer employees, saving the company over $1 billion. But those labor savings come at a cost. Laid-off workers close their accounts, and the bank loses fee revenue. Each department optimizes for its own efficiency, while the broader system suffers from declining demand. In food service, automation is rapidly changing the landscape. Fast food chains deploy self-service kiosks and experiment with robotic cooks, all in the name of efficiency. McDonald's digital kiosks process orders faster and reduce payroll expenses. However, same-store sales often decline in locations that automate, as former employees stop patronizing the business. The short-term savings are real, but the long-term loss of customers erodes the foundation of the business. Historical data reveals how the relationship between productivity and wages has broken down. In the decades after World War II, productivity and worker compensation rose together. Since 2000, however, productivity growth has far outpaced wage growth. AI threatens to accelerate this split, with projections of rapid productivity increases, but millions of jobs eliminated globally. The gains accrue to asset holders and executives, while most workers see little improvement in their standard of living. Real estate and healthcare illustrate the same pattern. Zillow's AI-driven home valuations speed up transactions, but lead to layoffs among staff who would otherwise be first-time buyers. In healthcare, AI diagnostics boost efficiency, yet staffing cuts follow, and patient access does not improve. The concentration of gains means that efficiency increases do not translate into better outcomes for the majority. Investment trends reinforce this imbalance. The vast majority of venture capital in AI goes toward labor-replacing technologies, not tools that empower workers or broaden economic participation. Companies invest heavily in automation, but allocate little to retraining or upward mobility programs. The result is a system where the benefits of productivity are narrowly held. Government statistics often fail to capture these realities. Employment numbers may look stable, but many jobs now pay less or offer fewer hours due to automation. Productivity metrics celebrate increased output per worker, but they ignore the shrinking base of consumers able to support the system. Even tech companies face the consequences. When AI replaces jobs, the resulting drop in consumer spending eventually limits growth in other business areas, like advertising or cloud services. The retail sector has already seen this play out, with automation driving short-term efficiency, but contributing to long-term declines in sales and community vitality. Financial services and education follow the same script. AI tools allow for leaner staffing, but the displaced workers often represent the very customers these sectors need. The feedback loop that once linked productivity gains to rising prosperity is breaking down, as automation and AI continue. To reshape the economy, the promise of shared productivity gains remains elusive. For many, the reality is a shrinking set of secure jobs and declining consumer power. This growing divide is the gig economy trap. The gig economy trap is reshaping the labor market as automation quietly transforms once stable jobs into piecemeal work with little security. Gig platforms position themselves as offering flexibility and entrepreneurial freedom, but the reality for most workers is a steady loss of stability and bargaining power. As automation eliminates traditional roles in manufacturing, retail, and services, more people find themselves turning to contract work not by choice, but by necessity. The numbers reveal the shift. Uber now has more drivers on its platform than the taxi industry ever did at its peak. Yet average take-home pay for drivers has fallen sharply over the past decade. DoorDash and Instacart boast record signups, but pay per order has dropped as more workers chase the same pool of gigs. For many, what started as a side hustle has become the only available source of income after full-time jobs disappeared. According to the Bureau of Labor Statistics, over a third of American workers now participate in some form of alternative work arrangement, triple the share from less than 2 decades ago. This is not a sign of rising opportunity, but of diminished options. Gig work, once framed as a temporary bridge, is becoming a permanent fixture. Nearly half of Uber drivers have been on the platform for more than 3 years, and a significant share of gig workers rely on these jobs as their main source of income. As automation spreads, the same pattern emerges across new industries. Amazon Flex has turned delivery into on-demand piecework. AI-powered legal and tech platforms break down complex roles into isolated tasks, offered to freelancers on a project-by-project basis. Each transition erodes pay, predictability, and benefits. The economic consequences extend well beyond the workers themselves. Gig workers spend less on discretionary purchases and delay major life decisions, such as buying homes or starting families. Data from major banks shows that mortgage approval rates for gig workers are far lower than for those in traditional employment, even at similar income levels. This reduction in consumer spending power ripples outward, affecting local economies and contributing to slower growth. When large employers replace steady jobs with gig contracts, they don't just cut costs. They reduce the number of reliable customers in the marketplace. The quality of gig work continues to decline as platforms optimize for profit. Algorithms now split rides and tasks among more workers, reducing earnings per hour. Platforms like TaskRabbit and Uber have lowered real pay over time, even as they increase fees for customers. Benefits are scarce. Less than 1 in 5 gig workers receives employer-sponsored health insurance, and almost none have access to retirement plans. Many turn to public assistance or go without coverage altogether, increasing strain on social safety nets. Financial insecurity is a constant companion for gig workers. Irregular income makes it difficult to qualify for credit or plan for the future. Many carry debts from previous careers, student loans, car payments for rideshare vehicles, or business loans for ventures that automation rendered obsolete. The instability seeps into every aspect of life. Studies show that gig workers report significantly higher rates of stress and anxiety compared to their traditionally employed peers, driven by unpredictable schedules and constant worry about making ends meet. Automation's next wave threatens to push even more workers into this precarious position. Customer service agents replaced by chatbots often move to freelance platforms where wages are even lower and hours less predictable. Retail workers displaced by automated checkout systems turn to app-based shopping gigs, only to find themselves earning less for the same work. As more industries adopt gig models, the cycle of declining pay and eroding consumer demand accelerates. Cities and businesses feel the impact as well. Areas with high concentrations of gig workers report lower sales tax revenues and reduced spending on durable goods. Restaurants and retailers see shrinking profits as more of their customer base becomes financially unstable. Even sectors that once seemed insulated, like healthcare, now struggle with missed payments from patients whose incomes fluctuate week to week. The gig economy, far from being a new frontier of opportunity, exposes the limits of an economic system that prioritizes efficiency over stability. As more workers are pushed into contingent roles, the gap between asset owners and everyone else widens. The platforms themselves continue to grow, but their success comes at the expense of the human infrastructure they depend on. While the challenges mount, policy responses have failed to keep up with the speed of change. The systems designed to protect workers and support communities have not adapted to the realities of gig work and automation, leaving millions exposed to new risks without meaningful safeguards. The policy vacuum. As automation and AI reshape the labor market, the policy response has lagged far behind the speed of technological change. The resulting policy vacuum leaves critical questions unanswered about how to manage the economic and social disruptions that follow. While governments debate the impact of automation, the market continues to reward efficiency and cost-cutting, often at the expense of long-term stability and worker well-being. Despite clear signals from the IMF and other institutions that 40% of global jobs, and as much as 60% in advanced economies, are highly exposed to AI, most countries have yet to develop a coordinated response. Only a handful have enacted any meaningful automation-related legislation in recent years, and most of those measures are limited in scope. For example, South Korea's modest robot tax simply reduced tax credits for firms that automate, a change quickly absorbed as a routine business expense. In the U.S., dozens of states still offer tax breaks to companies that invest in automation, inadvertently encouraging job displacement. Proposals for profit sharing or more robust worker protections stall in committee or are watered down by loopholes, rarely delivering real support to those who lose their livelihoods. Sector-specific regulations have failed to keep pace. Autonomous vehicle trials continue even as trucking regulations assume a human driver behind every wheel. Banking laws require physical branches, yet AI now handles the majority of customer service interactions. This mismatch between rules and reality allows automation to advance largely unchecked. In many cases, job titles are rebranded, call centers become digital assistance teams. But the underlying loss of employment is the same. Labor market policies remain anchored in an outdated understanding of work. Unemployment insurance systems still expect workers to search for jobs that may no longer exist, penalizing those displaced by automation. Exceptions for older workers or those in rapidly changing sectors are rare. Education policy is similarly misaligned. Public schools and vocational programs continue to channel students into fields that AI is already transforming, while only a few countries have reoriented curricula to emphasize skills that complement rather than compete with machines. Tax policy creates further distortions. Investments in automation often benefit from lower capital gains rates compared to payroll taxes on human labor, making it financially attractive for companies to replace workers with machines. This incentive structure accelerates the shift toward automation, widening the gap between asset owners and wage earners. Intellectual property and trade rules compound the issue. AI-generated work increasingly receives legal protections, while human-created content faces more hurdles. Trade policies protect certain manufacturing roles, but do little for service sector jobs, which are among the first to be automated or outsourced to AI systems based overseas. Worker classification systems are also outdated, relying on job categories that no longer reflect the realities of the modern economy. Safety nets and retraining programs are not designed for the scale or speed of technological displacement. Most unemployment insurance assumes workers will quickly return to similar roles, an assumption that fails when entire sectors are upended by automation. Experiments with extending benefits or targeting retraining have reached only a small fraction of those affected, often running out of funds before making a meaningful impact. Corporate governance and legal frameworks further entrench the focus on automation. Shareholders now expect executives to pursue labor-saving technologies as a matter of fiduciary duty, with legal precedent reinforcing the priority of cost savings over workforce stability. Local and national governments find themselves in a bind, providing incentives for automation while simultaneously funding retraining and support programs for those displaced. International efforts to coordinate a response remain fragmented. The G20's Automation Working Group has been inactive for years, and proposed global standards for responsible AI remain voluntary. Meanwhile, countries like China set ambitious automation targets with little international oversight or cooperation on managing the fallout for workers. This lack of comprehensive policy action has real consequences. Economic indicators like GDP and unemployment rates often fail to capture the depth of disruption caused by automation, as displaced workers move into lower-wage, less secure gig roles. Policymakers and business leaders may find reassurance in headline statistics, but the underlying economic fabric is changing in ways that these numbers can't fully reveal. The policy vacuum ensures that automation's advance is shaped almost entirely by market forces, with little consideration for the broader social and economic costs. As governments struggle to respond, the gap between technological progress and human well-being continues to widen. The effects of this disconnect are not just theoretical. They play out in the lives of individuals and families facing uncertainty and loss, a reality that is often overlooked when the conversation focuses only on numbers and trends. The human cost. Behind every data point on automation's advance is a person navigating a changing reality. The human cost of this technological shift is visible in stories like Sarah's, a paralegal from Ohio who lost her job after nearly 2 decades when her firm adopted an AI contract review system. She now splits her time between driving for rideshare apps and picking up freelance legal work online. Despite working more hours than ever, her income has dropped by more than half. Sarah's experience is not unique. Hundreds of thousands of legal support workers have faced similar displacement in recent years, each one contending with disrupted routines, financial stress, and the erosion of long-term career prospects. Mental health professionals are seeing new waves of distress tied directly to automation anxiety. Therapy sessions focused on job insecurity have surged, and regions hit hardest by automation in manufacturing and services report rising rates of depression and anxiety. In cities where factories or plants have automated, prescriptions for antidepressants and sleep aids have climbed. Workers describe persistent stress, disrupted sleep, and a pervasive sense of being left behind by forces beyond their control. The psychological strain is compounded by the uncertainty of finding stable work in a labor market that increasingly values adaptability over experience. Downward mobility is another consequence. Experienced managers and skilled professionals, after being replaced by automated systems, often find themselves competing for entry-level positions at much lower wages. The statistical measure of employment may not capture the loss of status, identity, and self-worth that comes with this shift. For many, the transition means moving from a position of responsibility and respect to roles with little security or opportunity for advancement. Physical health suffers as well. Stable employment once provided not just income, but also access to healthcare, social networks, and a sense of daily purpose. Studies have found that displaced workers experience higher rates of chronic illness, including heart disease and inflammatory conditions, within a few years of job loss. The stress of adapting to gig work or temporary roles, combined with the loss of health benefits, exacerbates these problems. In automated warehouses, remaining workers face relentless productivity targets set by machines, driving up rates of repetitive stress injuries and workplace accidents. Family life and community ties are strained by economic instability. Divorce rates rise in regions undergoing rapid automation, and children in these households perform worse in school, with lower graduation rates and diminished prospects for upward mobility. The effects ripple outward. Local businesses close, social organizations shrink, and the fabric of community life weakens as steady paychecks disappear. The loss is not just economic, it is social and generational. Older workers encounter particular challenges, competing against AI-driven systems and younger applicants for the few remaining roles. Many face age discrimination or are forced into early retirement. Retraining programs rarely bridge the gap, leaving them with limited options beyond low-wage, insecure work. The erosion of traditional stepping-stone jobs, once a path to economic security, means younger workers and students also struggle to gain a foothold. The pressure to adapt leads some to take desperate measures, such as falsifying credentials or working outside legal boundaries, just to make ends meet. These choices reflect not a lack of ambition, but the dwindling availability of dignified work in an economy shaped by relentless efficiency. The shift is now reaching white-collar professions once thought immune. AI-generated marketing, automated legal research, and algorithmic design tools are displacing highly educated workers, undermining the belief that more education guarantees stability. The resulting frustration is palpable among those who invested years in training for careers now threatened by automation. Healthcare systems feel the effects as well. Hospitals and clinics in automation-heavy regions report more stress-related admissions, while preventative care visits decline as newly uninsured individuals delay or forego medical attention. The toll of economic uncertainty appears in rising rates of chronic illness, substance use, and reduced life expectancy. These changes are not isolated incidents. They reflect a broader pattern of disruption that extends from individual households to entire communities. As automation continues to reshape the world of work, the consequences extend far beyond lost jobs or lower wages. They touch on every aspect of daily life, setting in motion cycles that reach well beyond the initial shock of displacement. This growing human toll is not just a byproduct of progress. It is a warning sign of deeper, self-reinforcing trends that threaten to destabilize the very foundations of economic and social life. The automation feedback loop. The automation feedback loop is a cycle that quietly intensifies the strain on both businesses and workers. Each new wave of automation promises efficiency and cost savings, but it also quietly reduces the number of people who can actually afford to participate in the economy. When a retailer installs self-checkout kiosks, it may cut dozens of cashier jobs. The immediate result is lower payroll costs, but those former employees are no longer regular shoppers. Sales dip, and the company looks for more places to cut, often by automating additional roles. The pattern repeats. Each round of efficiency gains further reduces the pool of customers, making it harder for businesses to grow or even sustain their operations. This cycle is visible across nearly every sector. Amazon's warehouses now operate with far fewer workers than just a few years ago, but the company has also reported softer sales growth in regions hit by layoffs. When people lose steady paychecks, they cancel subscriptions and delay purchases. In banking, the adoption of AI-driven service platforms led to significant staff reductions. The resulting savings look good on financial statements, but mortgage applications and new account openings decline in areas where layoffs are concentrated. The very people who once powered growth are no longer in a position to spend. Manufacturing tells a similar story. Automation allows factories to produce more with fewer employees, but those missing paychecks translate directly into lost demand for the products rolling off the assembly line. Industry data shows that for every job eliminated, there is a measurable drop in local consumer spending. Executives may celebrate higher margins, but they also quietly acknowledge the growing challenge of finding buyers for their output. The service sector is not immune. Restaurants that automate ordering and payment systems often see an initial bump in efficiency, but regulars, many of whom were former employees, stop coming in as often. The owner, facing declining revenue, cuts back on kitchen staff or reduces hours, which further impacts service quality and customer loyalty. Over time, the business may close, joining the growing list of establishments unable to adapt to the shrinking customer base. Technology companies face a version of this loop as well. Platforms like Google and Facebook rely on advertising revenue from small businesses, but as those businesses automate and cut staff, their marketing budgets shrink. Internal projections show that every large-scale reduction in employment leads to a noticeable dip in ad spend, eroding the foundation of the digital economy. Credit markets amplify the problem. As more workers move into unstable gig roles or lose jobs entirely, banks tighten lending standards. Fewer people qualify for mortgages or car loans, which reduces sales for home improvement stores, auto dealerships, and other interest-sensitive businesses. The contraction in lending ripples through the economy, reinforcing the downward spiral. Government attempts to intervene often fall short. Unemployment benefits and retraining programs provide temporary support, but they rarely replace the lost purchasing power of a full-time salary. Cities facing declining tax revenue cut public services, which further weakens local economies and makes recovery more difficult. Healthcare systems see the feedback loop in action as well. Hospitals that automate administrative roles save money in the short term, but when laid-off workers lose insurance, they delay or forego medical care. The result is a rise in uncompensated care and a drop in elective procedures, offsetting the initial savings and straining the system's finances. The standard economic argument suggests that productivity gains should eventually lead to new jobs and higher living standards. In practice, the pace and scale of AI-driven automation have outstripped the mechanisms that once balanced disruption with new opportunities. The system now optimizes for efficiency at the expense of demand, creating a self-reinforcing cycle where each cost-saving measure leads to further reductions in economic activity. This feedback loop is not just an abstract concept. It is a daily reality for businesses, workers, and communities. The consequences become more visible as automation advances, calling into question many of the assumptions that have guided economic policy and business strategy for decades. The Silicon Valley blind spot. Silicon Valley's leadership still operates on the belief that technology always creates more jobs than it destroys. This assumption, rooted in the history of past industrial revolutions, fails to account for the unique speed and scope of AI-driven automation. Previous shifts, like the rise of steam engines or personal computers, took decades to reshape the labor market, giving workers and industries time to adjust. AI, however, can replace cognitive and routine roles in a matter of months, not years. The gap between the optimism of tech leaders and the reality faced by displaced workers continues to widen. The data exposes this blind spot. While the number of software developers in the U.S. grew by more than 40% between 2012 and 2019, other technology jobs, such as computer network architects and systems administrators, declined over the same period. This pattern repeats across industries. AI creates a handful of high-skill opportunities, but eliminates far more middle skill and support roles. IMF research estimates that 60% of jobs in advanced economies are highly exposed to AI, with clerical and administrative positions most at risk. Managers may benefit from AI as a complement to their roles, but the majority of support staff simply vanish from the workforce. Examples from leading tech firms illustrate the disconnect. Tesla cut 14% of its workforce last year, while touting advances in self-driving technology that could eliminate millions of driving jobs worldwide. Yet, as the company automated, sales growth slowed. Many of those let go were also customers. Google automates ad sales, even as small businesses, which employ vulnerable workers, form the backbone of its advertiser base. Venture capitalists fund AI startups that disrupt industries, often overlooking the fact that their other portfolio companies depend on the very workers being displaced. Startup culture intensifies the problem. Founders routinely pitch investors on the promise of disrupting industries by removing labor costs. A recent example saw a Y Combinator-backed startup proudly announce it had replaced dozens of insurance adjusters with AI, never acknowledging that those lost salaries once supported car purchases and mortgages. Silicon Valley celebrates headcount reduction as a metric of success, then acts surprised when consumer demand weakens. The pace of change outstrips adaptation. In the past, technological disruptions gave workers time to retrain or transition. The internet took over a decade to transform publishing. AI-driven automation can wipe out entire job categories in just a few years. IBM's own studies show workers need hundreds of hours of retraining to shift careers, yet AI makes some roles obsolete faster than workers can adapt. A truck driver cannot realistically retrain for a new profession before autonomous vehicles are on the road. Tech leaders often misjudge which jobs are secure. Claims that AI will create countless new roles don't match the numbers. Programming jobs, once considered future-proof, declined as AI coding tools matured. Graphic design listings have dropped sharply since the arrival of generative AI. Even core engineering roles in Silicon Valley are increasingly vulnerable to the very technologies being developed there. Investment patterns reinforce the short-term thinking. Billions flow into AI startups focused on labor replacement, while only a fraction goes toward workforce adaptation or retraining. Major tech firms spend vast sums developing automation tools, but allocate little to supporting those displaced. The incentives clearly favor disruption over solutions. Economic models used by tech executives rarely account for the demand that disappears when workers lose their income. Productivity gains look good on spreadsheets, but they don't compensate for the shrinking pool of consumers able to buy goods and services. The mantra of move fast and break things falters when the broken pieces include your own customer base. Geographic and social isolation deepens the disconnect. The high incomes and insulated communities of Silicon Valley executives make it easy to overlook the realities facing workers earning a fraction of their salaries. Surveys show that many tech leaders consistently overestimate average U.S. wages, underestimating the impact of widespread job loss on consumer demand. This optimism is reinforced by survivor bias. Founders and investors who succeeded in the past assume the same pathways will remain open, even as AI threatens to automate away the entry-level tech jobs that once launched careers. The startup ecosystem that enabled their success could soon be out of reach for new entrants. Policy debates reflect the same disconnect. Tech leaders often endorse universal basic income as a solution to job loss, tacitly admitting that automation will not create enough new jobs to offset displacement. Yet, they resist measures like robot taxes or regulations that might slow the pace of change to more manageable levels. Occasionally, market realities break through. When Meta's automation of content moderation led to reduced ad revenue, or when Microsoft's AI tools threatened the IT departments that buy its products, even Silicon Valley was forced to confront the limits of efficiency-driven thinking. The lessons of history are clear. Efficiency gains that ignore the health of the broader economy can backfire. The current approach risks repeating the mistakes of past industries that optimize themselves into decline. As automation accelerates, the consequences of this blind spot will not be felt the global divide. Automation is redrawing the global economic map, exposing sharp differences in how countries experience both risk and opportunity. The global divide isn't just a question of who builds the most advanced AI, but of how each nation's workforce, industries, and institutions absorb the shock of rapid change. Advanced economies are at the forefront of disruption, with the IMF estimating that 60% of jobs in these countries are highly exposed to AI. Office and administrative roles, common in the US, Western Europe, Japan, and South Korea, are especially vulnerable as algorithms and robotics replace tasks that once required years of training. In these places, the challenge is not just job loss, but the speed and scale at which entire career paths vanish. China's dual trajectory highlights how automation can reshape a workforce on more than one front. The country's factories are set to eliminate millions of assembly line jobs through robotics by 2030, but at the same time, China is expanding its AI research and tech sectors at a breakneck pace. Cities like Shanghai and Shenzhen are hiring thousands of engineers and data scientists, creating new opportunities for a segment of the workforce. Yet, most factory workers will not transition into these roles, and the gap between those who adapt and those left behind is widening. The result is a split labor market, where some regions and groups surge ahead while others confront deep uncertainty. India's experience is shaped by its large, services-oriented economy. AI is expected to boost growth in software and financial technology, especially in urban hubs like Bangalore. But the same technologies threaten millions of routine back-office and call center jobs that have been a mainstay of employment. Automation in these sectors is advancing quickly, leaving many workers at risk of displacement. While India's young, tech-savvy population is well-positioned to fill some new roles, the sheer scale of change means that not everyone will benefit equally. The skills gap between high-growth tech jobs and the reality of routine office work remains a persistent obstacle. Japan and South Korea offer a different kind of adaptation. With shrinking populations and aging workforces, both countries are turning to robotics and AI to fill labor shortages. Automation here is less about replacing workers and more about maintaining productivity as the labor pool contracts. This approach may cushion the blow, but it also changes the nature of work, requiring older employees to upskill or move into new roles. The pressure to adapt falls hardest on those least prepared for it, especially in administrative and clerical positions. In Southeast Asia, lower labor costs and slower tech adoption have delayed the impact of automation. Countries like Indonesia and Vietnam continue to rely on manual manufacturing and agriculture, which are less susceptible to immediate disruption. Still, this delay brings its own risks. Without investment in higher skill industries, these economies may find themselves stuck in low-value production, unable to compete as global supply chains modernize. Singapore and Vietnam are beginning to cultivate tech sectors, but the transition is gradual and uneven. Africa and Latin America face a different set of challenges. Many jobs remain informal or manual, making them less vulnerable to automation in the short term. However, this also means these regions risk missing out on productivity gains that could drive economic growth. Sectors like mobile banking and agritech show promise, but they are not large enough to absorb the millions entering the workforce each year. For now, the benefits and disruptions of automation are concentrated in small pockets, while most workers remain on the sidelines. Europe's response has centered on reskilling and social safety nets. The EU and national governments invest in digital literacy and retraining, but these efforts cannot fully offset the loss of stable middle-class jobs. Regional disparities are growing, as tech hubs attract investment and talent while traditional manufacturing regions struggle. Within the United States, the divide is internal as well as international. Tech hubs on the coasts create high-paying jobs in AI and data science, while service and manufacturing workers in the Midwest and South face shrinking opportunities. The educational and geographic gap between those who benefit from automation and those who do not continues to grow. As automation advances, these differences are shaping a new global order. Countries and regions that adapt quickly to technological change will capture the gains, while others risk falling further behind. The result is a world where economic and social outcomes diverge, and where the choices made today will set the course for decades to come. This landscape is not static, and the pressures it creates are building toward a point where established systems and assumptions may no longer hold. The endgame. The endgame for automation is not a single outcome, but a set of branching possibilities shaped by choices made at every level, corporate, political, and individual. As AI and robotics move deeper into the economy, the question is no longer whether jobs will change, but how fast, for whom, and with what consequences. With 40% of global jobs already facing some level of automation risk, the scale of transformation underway is hard to ignore. The real issue is what will fill the gap left by traditional work as the core of economic participation, and whether the gains from automation will be broadly shared or concentrated among a shrinking group. Productivity numbers suggest enormous potential. McKinsey estimates the long-term AI opportunity could add $4.4 trillion in productivity, with companies across sectors reporting higher output and lower costs. But these gains are not translating into higher wages or broader prosperity. Automated factories can produce more cars with fewer workers, but those workers were also customers. As labor costs drop, so does demand, leading to a cycle where efficiency improvements undermine the very markets they depend on. The math works for a while, until it doesn't, when too many people are excluded from the economy and consumption slows. The direction this transition takes depends heavily on policy and ownership structures. One scenario sees wealth and power consolidating as automation's rewards flow mainly to shareholders and executives. In this version, most people rely on government transfers or precarious gig work, while the benefits of technology accrue to a narrow elite. Current tax systems, which favor capital gains over labor income, reinforce this path. An alternative is possible, one where automation's gains are distributed more widely. This could mean profit sharing, shorter workweeks at full pay, or new forms of worker ownership. The difference comes down to choices about who benefits from technological progress and how the rules are set. History offers only partial guidance. Earlier industrial revolutions unfolded over generations, giving societies time to adapt. Steam power and electricity changed work gradually, allowing new roles to emerge. With AI, the pace is much faster. Legal research, medical diagnostics, and creative work can be automated in months, not decades. Education systems and retraining programs struggle to keep up, leaving many workers with skills that depreciate faster than they can adapt. The risk is a growing mismatch between what people are trained for and what the market actually needs. Ownership and governance shape the pace and impact of automation. Employee-owned companies often move more cautiously, weighing community stability against efficiency. Publicly traded firms, under pressure to deliver quarterly results, tend to automate aggressively, sometimes with little regard for long-term effects. Private equity accelerates this trend, pushing for rapid cost savings even if it means greater instability. These incentives steer the outcome toward either social resilience or greater inequality. The effects of automation ripple through every part of society. Pension systems built around stable, long-term employment face strain as careers become shorter and more fragmented. Health insurance tied to traditional jobs becomes harder to sustain. Even the infrastructure of cities, designed for daily commutes and regular work hours, grows out of sync with decentralized, unstable employment patterns. Social and psychological impacts are just as significant. Work provides more than a paycheck. It organizes daily life and gives people a sense of purpose. As automation reduces the need for human labor, rates of depression and anxiety rise in places hit hardest by job loss. Communities lose cohesion and identity fractures as familiar routines disappear. The abundance promised by automation means little if people no longer feel useful or connected. Financial markets are not immune to these shifts. Investors price in expected cost savings from automation, but often overlook the risk that demand will falter as more people lose stable incomes. Stock prices may rise on news of layoffs, but declining sales and shrinking markets eventually catch up. The feedback loop between employment, consumption, and growth becomes more fragile as automation spreads. The outcome is not predetermined. The endgame will be shaped by how societies choose to distribute the benefits and costs of automation, how businesses balance efficiency with long-term demand, and how individuals and institutions respond to rapid change. These decisions will determine whether automation leads to greater prosperity for all or deepens existing divides. The next stage will require confronting the paradox at the heart of this transition and deciding what kind of future is worth building. As automation accelerates, businesses face a critical dilemma: boosting productivity by cutting jobs risks eroding the customer base that sustains growth. AI may streamline operations, but if too many workers lose stable incomes, demand for goods and services inevitably falls. The challenge is not halting innovation, but designing systems that share the benefits more broadly across society. Policies such as profit sharing, shorter work weeks, or targeted taxes could help ensure that gains from automation do not only flow to shareholders. The real measure of progress will be how effectively we balance efficiency with fairness, so that technological advances improve living standards for everyone.